Well, in one of your YouTube videos, you actually said that you're currently $600 million in debt. No?
1.2 billion.
1.2 billion, okay. There we go.
Robert Kiyosaki is a businessman, financial guru, and the author of 26 books. The most popular being his best-selling book, Rich Dad, Poor Dad. He's been credited with transforming millions of people's finances with his Rich Dad, Poor Dad book. I'm Terrell Higgins, a real estate and personal finance nerd, and today we're going to be explaining why Robert Kiyosaki has $1.2 billion worth of debt. This is going to go well beyond the generic good debt, bad debt discussion. We're going to be fundamentally changing the way you think about debt.
So my goal, my wife's goal every single year is we increase our assets. So we buy more rental property, we invest in oil, gold, stocks that pay dividends and all this. So every year, our income or our cash flow keeps increasing. Every year. Our goal is not to get a higher paying job. Our goal is to keep increasing our assets.
So I want to start this discussion on the power of compound interest. This will be the foundation of explaining why Robert Kiyosaki is interested in taking on so much debt. So I'm going to leave a link to this spreadsheet in the description below. But what I'd like to show is how little you actually have to contribute if you have time on your side in an investment. So right off the bat, you can see that the initial investment, I'm assuming, is $0. Current age is 0, so you start contributing to like your kid's account when they were first born. And then I have monthly contributions set at 0. And then this interest rate, I'm assuming on the investment, is 10%. That's in line with what you should expect to get from an S&P 500 index fund. Right around 10 to 11% year over year. And then this last little section is showing how much you actually have to contribute every single month to reach $1 million by age 65, which is normal retirement age. And you can see if you start contributing right away, it's only $13 a month. It's a very, very small amount. If you're around 30, you really need to be targeting around $30,000 in investments to be able to coast your way to $1 million by the time you hit retirement age. So if we change our current age here to 30 and our initial investment to 30,000, and then we'll change our monthly contributions to 0, you can see that by age 65, we are hitting $1 million even without this $5.37 per month that it's saying we need to contribute. Because by the end of our 65th year, we are above $1 million. And right around 64, you're hovering just below $1 million. So if you can hit 30,000 by 30 with normal returns in the S&P 500, you're on track to hit $1 million by retirement age. And like I said, I'll leave this calculator in the description below for you guys to download and play with. So you can plug in how much money you have saved, your current age, and how much money you're contributing to see where you are on your financial journey and what you're on pace to earn later in life.
But while some financial experts are saying get out of debt, I'm saying learn how to use debt. So when I came back from in Vietnam in January of 73, the first thing my rich dad said to me was go to school to learn how to invest in real estate. It wasn't real estate, it was how to use debt and taxes. Debt and taxes make the rich richer.
Now let's explain the power of debt in this compounding cycle. So assume you have $20,000. If you have $20,000 and you invested it in an S&P 500 index fund where you're getting 10% per year, that's going to be $2,000. So you can take that same $20,000 and put it as a 20% down payment on a home, and that will allow you to buy a $100,000 home. So if you got a 10% return on a $100,000 home, which is not unheard of because of the cash flow and equity growth on the home, you're going to get $10,000, which is a lot more than $2,000. So you don't actually get to pocket all that money. There is debt associated with that property. So assume you had $80,000 of debt because you did a $20,000 down payment, and then you're making interest-only payments on that debt. So you're making interest-only payments at 7.5%, which is in line with current interest rates. 7.5% on that $80,000 is about $6,000. So $6,000 out of your $10,000, you're still left with $4,000, which is more than double what you would get if you didn't take on that debt and leverage your investment.
So all the money I make, if I buy something with debt, that's $1.2 billion in debt, because if I go bust, the bank goes bust. Not my problem.
Isn't his problem, it's the bank's problem. And to really understand what he meant by this, we have to break down a very fundamental concept. And it's the difference between recourse debt and non-recourse debt. So recourse debt is the debt that most people are familiar with. This is student loan debt. This is credit card debt. This is the debt that you have on your mortgage. It's auto loan debt. So when you have recourse debt, they look at your overall financial health, looking at your credit score, your debt to income ratio, the income that you have coming in each month, and all the assets that you have to see how you could repay this loan if you fell on a hardship, a financial hardship. If you stop paying on recourse debt, they can retake the collateral that is available from that loan. So if it was an auto loan, they're going to seize the vehicle. If it's a home loan, they're going to foreclose on your house and take your home. If it's a boat, they'll take back the boat. Whatever underlying collateral, they'll try and take back. And then they can go to court and try and garnish your wages to continue paying on that debt moving forward, or even sue you to try and repay the full value of that loan. But implicit in the agreement for recourse debt is that you will repay the loan with all available assets that you have available to you. Then the other type of debt is non-recourse debt. And this is debt that is backed by an underlying asset. So what I mean by that is that the underlying asset is producing income that can actually pay for the debt. The bank's going to analyze that asset to see how much more than the debt burden the asset can pay. And if there's enough margin there, then they will underwrite the loan and give you the loan. And they won't look at any of your personal finances, not your debt to income, not all your personal assets. The only thing they care about is the property itself. If you stop paying on the loan, the only thing that the bank can actually seize is the underlying asset. So whatever the cash flowing asset is, that's the only thing at risk with non-recourse debt. The loan type that actually allows you to do this is called a debt service coverage ratio loan. So for a debt service coverage ratio, they're actually looking for a ratio of 1.1 to 1.2. And what they're saying is that the underlying asset has about 10 to 20% net cash flow available to it above what the debt burden is going to be. And if you want a very strong chance of a property getting approved, you want about a 25% net cash flow above the debt burden. So this key difference between recourse and non-recourse debt is why Robert Kiyosaki said that if he stops paying, That's the bank's problem, because they will be stuck trying to figure out how to recoup their initial investment from the asset. So what's the takeaways from knowing this recourse versus non-recourse debt knowledge? If you have non-recourse debt, you're actually shifting the risk from your personal finances to the bank. So as you take on more debt, you're not actually escalating the debt for your personal finances, which is a very powerful tool to manage risk in the overall portfolio that you're constructing. But what I'm not saying is that you should be taking out tons of recourse debt. I'm not saying to rack up high interest credit card debt or take out a bunch of personal loans or have a huge auto loan payment. Having very large amounts of recourse debt puts you in a very unstable financial position and at risk of having to file for bankruptcy.
We're reading this book called Rich Dad, Poor Dad, right?
Yeah.
And just, you know, just that whole book, I think, like, of him just, it's like he's guiding me, like, throughout the whole book. 'Cause
Why did you want to share that book with your son?
You know, it's interesting that no matter how successful you get, it's really difficult to shake your mindset. And I still have a poor person's mentality. I can't shake it, and it gets really detrimental when you can't just shake off the ideas. It's like when I go to sleep at night right now, I'm as financially nervous as I was 20 years ago.
You are.
Absolutely.
Really?
You shook it. Well, I mean, you did it. You're doing a little more than us.
No.
If I've completely reshaped your understanding of how debt works, please like and subscribe so other people can find this video and we can appease the YouTube algorithm. And if you are curious how the ultra wealthy also use debt to not pay any taxes, check out my buy, borrow, die tax strategy video. It lays out everything you need to know about building generational wealth and passing it down to your heirs and paying 0 taxes. Thanks for tuning in. We'll catch you next time.